Today we are going to study the next phase of income from house property. So, how to compute income from house property? This is the format. First, we start with gross annual value. From gross annual value, you need to deduct municipal tax. From that value, what you get is called as net annual value. From that, under section 24, there are two deductions. Deduction under section 24, 30% of NAV, and interest on loan, there are pre-construction interest and post-construction interest. From that, you will come to know what is the income from house property. Now you need to know the terms what we used here. So in gross annual value, we compared MRV with FRV, and then we compared standard rent, and then we compared with actual rent. So let us see what is municipal MRV. MRV is nothing but the municipal rental value, which means the property is fixed by municipal, the rental value of the property will be fixed by the municipal authority to levy municipal tax. And fair rental value means it is a rental value similar to the accommodation in the same locality. And standard rent is the minimum rental value which is fixed under rental control authority. And the annual rental value, it is nothing but the rent what you are receiving as an owner. The rent what is received by the owner is called as annual rental value. So while finding out the real rent, any expenses like water, garden maintenance should be excluded from the calculating of actual rent. And composite rent, what is composite rent? It is rent collected by the owner for house property for let out along with the facility of water, gardening, staircase, lighting, security, pump maintenance, etc. So composite rent should be split into annual rental value and service charges. Next is unrealized rent. Unrealized rent means the rent which you have not realized due to many situations. So, like the default of tenant has vacated, defaulting tenant has vacated, or steps have been taken to compel him to vacate, or defaulting of tenant is not in an occupation of any other property of an assessee. So, these all are considered as unrealized rent. And vacant also can be deducted from your actual rent, that is, which is nothing but the house is being kept vacant without getting a rent over the period of maybe 2 months or 3 months. That is called as vacant period. Next is deductions. As we saw, what from after deducting your municipal tax, you get a net annual value. From that, there are basic deductions. So here, the deductions under section 24. So in case of self-occupied house property, so deduction under section 24. If there is any self-occupied property, addition of up to 1 lakh extra we can claim under section 24. So there is a, before that there is a provision on deductions, like any house property can be, you can claim deduction more than 2 lakhs if a loan is being taken after 1499. If any loan is taken before 1499, up to 30,000 only you can claim. Apart from that, you can claim additional of 1 lakh, but there is a condition for that, which means the loan should be a fresh loan and the loan should be taken only for 35 lakhs, and it is a first time loan is being taken by the assessee. In that case, additional 1 lakh you can claim under 80 EE. So, and second deduction, I told you interest on loan, there is a pre-construction and post-construction. Pre-construction means it is an interest payable for the period commencing from the day you borrow till the day of repayment or 31st March of previous year in which construction is completed. So, whichever comes early, you consider as a pre-construction period. Post construction means the current year interest which we need to pay, which means still the loan is going on, means this year's what is the interest you need to pay, that is called as post construction. You can see a graph here. So pre construction means the day you borrow the loan and it ends either your repayment or your completion of house. In this two, whichever is coming early, up to that you can claim pre-construction. Suppose if your construction is coming early means you cannot take construction date, but immediately the immediate preceding immediate previous year when the construction is completed, you can consider. Say for example, the house is the loan is borrowed in 2017, 2017, and the loan house is completed in the year 2020, but the loan is still going on. So here, which is coming early? The house is coming early. Suppose the house completed in the month of January 2020 means the preceding, immediate preceding previous year was what? 31st March 2019. So from the date 2017 till 2019, you can claim pre-interest. And post-interest is till the loan is pending, till you need to pay the interest. In that case, you can claim post interest. I think this video might be useful for you. Thank you.